Hello, and welcome back to the Banking Revolution. I'm Liz Lumley of The Banker, and this morning our panel is looking at, is tech the answer to modernizing finance for the good of all? We're seeing more and more banks, moving away from their legacy systems and embracing digital and moving to technologies like cloud. But is this the silver bullet that banking needs? We've got a wonderful panel here today to discuss this interesting topic. So I'm going to have them come on and introduce themselves. So I want to introduce Cynthia. Please come on and tell us a little bit about yourself briefly.
Thank you. My name is Yawandia. I'm co-founder and CEO of Quara. And Quara is on a mission to bring financial services to a billion people by turning existing credit unions into modern digital banks. Extremely be here.
Excellent. Anna, can you introduce yourself, please?
Sure, absolutely. And thanks for having me. I'm Anna, responsible for ESG and sustainability at Mambu, the software as a service cloud banking platform. And I'm really exploring our unique position in the finance system, finance ecosystem, and digital technology to see how can we create a healthier financial ecosystem. So really excited to share some perspectives today.
Wonderful. And last but not least, Tarun, please introduce yourself.
Hi, everyone. I'm Tarun Ramadurai. I'm at Imperial College London. I'm a professor of financial economics. I study a lot of topics in fintech and household and retail finance and banking as well. And I am really looking forward to being a part of this very exciting panel.
Wonderful. So in addition to our discussion that we're about to start, we're also taking questions from the audience. So should you have any questions, please put them in the chat on your screen. I can't promise we might not get to all of them. So please make them interesting. That get ups your chances of them being asked on air, and we'll see if we can get to them during the panel. So I'm going to start off with my first question. And I mentioned in my introduction, legacy systems. Legacy systems is often cited as a barrier, after regulations for financial services firms when they seek to embrace new technologies, to innovate or modernize their systems. And I really kind of want to know, like, where the truth lies in this. Are legacy systems such a barrier as a lot of people seem to think they are, or are they an excuse? So I'm going to go to the academic first. So Taryn, I wanted to start with you on that.
It's interesting that this debate about legacy systems that is now in fintech and banking has actually been around in many industries over the years. So there's a famous set of anecdotes and case studies that the academic Clayton Christensen had about disruptive innovation, which was when the Bessemer converter came into the steel industry. So the problem there was many people had these big blast furnaces, which were these old legacy technologies. And the upshot of that was that these small upstart manufacturers that adopted the Bessemer converters very quickly became the new gigantic corporations producing steel in that industry. So while it might be true that legacy systems are an excuse in pre-existing operations to make change, all that does is it increases the possibility that upstart fintechs will come in and really take over the system because they're just much more nimble, able to adopt technology very quickly, and we're seeing incredibly rapid growth. So, for example, PayPal now is far, far bigger than anyone anticipated it would ever be. It's one of the largest corporations in the world, and it's basically started from a standing start. And so, really adapt to survive is the message here.
Interesting. Yeah, no, Anna, I want to move over to you because I think Mambu is in a very interesting position to see that this issue kind of from the inside as a newer company, but also in the core banking space. So Anna, what do you think?
Yeah, so when we talk about innovation in financial services and modernization, I always ask myself, well, what does that future actually look like, right? And what kind of financial services do we need in that future? we are inevitably looking at a transition to a low carbon economy. We have to do it in this decade if we want to continue having a financial system at all. And this really will mean retooling entire economies as we know it, right? Think about building out all of the infrastructure for renewable energy. Think about redesigning our cities, renovating our building stock, and building new housing. And doing all of this in a way that is inclusive, that doesn't create trade-offs elsewhere, and that is fast, because we really have a short window to act. And this is not a small task ahead of us. And the way the financial sector responds to this call right now will determine how well society is prepared to deal with climate change in the future, but actually now already. So we need completely new and different financial products, whether that's in the lending infrastructure, in the capital markets infrastructure, or in retail infrastructure. And from this perspective, I think legacy systems just don't lend themselves that well to creating the type of architecture that we need, given the scale and complexity of innovation that is ahead of us.
No, interesting. Yeah. So I really wanted to talk a bit about some of the strategies then to jump over these barriers. So I'm going to go to Cynthia for this to see, what your viewpoint is.
Yeah, what we found has been effective so far includes, first of all, handling some of the anxieties up front. I think it's on occasion it's easy to see from an outside perspective all the benefits of innovation and upgrading when you're not necessarily the one who's responsible for this legacy system that has been procured, that you've been maintaining and taking care of. So handling some of these anxieties upfront, walking through existing attachments to the infrastructure or to the processes, and just supporting some level of circularity and sustainability there has also moved those conversations much faster forward. At the same time, shining a light on the opportunity cost. I remember painting a picture to one of the credit union leaders on what the average day of a 20-something-year-old looks like, and the interfaces with financial systems and financial services not looking anything like they used to before. And with the current strategy and infrastructure, they were never going to be able to interface with this particular type of prospective client. And so both of those have been pretty effective. I also do think that tech firms can and should take some of that risk internally in terms of handling what the concerns with those legacy systems would be. It means taking that first step to show reliability, to show even the zero risk kind of trial method works really well, so that you actually build up a partnership. Then the innovation doesn't feel like they're going into it alone. It doesn't feel as scary.
No, interesting. Yeah, we apologize. We had a slight technical issue with your sound during your answer. So, but as we know, we've all been in this world for the past 18 months. But we got most of what you were talking about, Cynthia. But I'm glad you talked about banks taking responsibility for dealing with their legacy systems and moving forward. And I wanted to talk a little bit about cloud. I mean, my experience with this industry is, 10 years ago, cloud was a word you couldn't mention at banks. It was a very dangerous word. And now, of course, we're living in a world of cloud and as a service and open APIs, which is now being embraced by banks and by financial services firms. So in terms of, banks taking responsibility for moving forward, what changed in this industry? Why are these technologies now being embraced? So Anna, I wanted to go to you for that one.
Yeah, so building up on what's been said, right? So banks today face two types of challenges when it comes to the sustainability transition. And I don't mean just climate change, I mean all issues that are wrapped up in the sustainable development goals, right? Including gender inequality and poverty. And on the one hand, banks need to understand, well, how are they contributing negatively to these issues through their own financial decisions, right, from what they decide to invest in. And on the other, they need to know about the positive solutions that they can apply their capital to. And a lot of this ultimately comes down to informed decision making and better data. And when I say better data, I don't mean just more of it. I mean data coming from varied sources, coming in real time and in a way that you can actually translate it to financial metrics. And here, open banking and other digital technologies have certainly enabled banks to break through these data silos and tap into the type of data that actually, well, supported them in this better decision making, right? So, for example, banks now can track whether they are exposed to environmental and social risks in their portfolios and make decisions whether to continue to finance these activities, right? They are able to connect to small scale renewable energy providers or other small businesses that were usually buried a little bit in the market, right? Because they're so small. In payments and accounts, for example, open banking allows to connect user transactions to data, to sustainability data, so customers can start seeing the impacts of their individual purchases and can start changing their behaviors. So all of this is very powerful, and it's driving a lot of competition in retail banking for consumers, for conscious consumers, but more generally also it is helping banks respond to the changing regulatory environment from capital market regulators and policymakers about their own sustainable finance and ESG shorthand, right, credentials and their own performance. So digital technology enabled that, and certainly banks are using that to respond to the challenge.
Yeah, no, we're going to get on to regulations in a bit, but I've got a question from the audience, and I'm gonna go back to Anna for, because I know that she wants to talk a lot about the ESG issues and sustainability. So what are you seeing? What are banks doing to remain sustainable right now?
Yeah, so I was going to come to that in one of the questions, but really,
Mm.
there is capital market regulators right now and securities exchange regulators. They're really putting out the legislative infrastructure in place to actually understand better and get a better handle on controlling the flow of capital towards sustainable activities. But not just that, you also see a lot of consumer demand and people who are starting to feel and see the challenge, the impacts of climate change, and they're asking themselves a question: well, how's my money working? What's it being put to? What kind of use is it being put to? And so banks are experiencing pressures from all sides and on all constituents. There's a question in the chat, right? Well, banking is managed by bankers only. Well, I think that's changing. I think there's a lot of different requests coming to banks from all stakeholders, and banks are certainly responsive to that because they have to if they want to remain relevant in the future.
Yeah, so I wanted to bring Taryn in a little bit to talk about this sort of the regulatory challenge and whether it's it's hindered or it's a barrier, or they're really working with banks on a lot of these issues. What do you think about the regulatory compliance challenge?
So, I mean, yeah, let me sort of opine on a few things that have been said so far in the debate, which I think are important, and sort of we'll tie that in with the regulatory challenge towards the sort of end of these remarks, which is the first thing is that, there was this discussion about the cloud and the sort of reluctance of
Mm.
banks with the adoption of cloud-based technologies. And I think there are sort of two things that I think are important to consider that are often neglected points in this discussion. The first one is that putting data into the cloud makes switching a lot easier for consumers. And that is something that is, on the one hand, it's a great benefit for the consumer, but on the other, it is a potential detriment from the bank's perspective because you no longer have a captive audience. And the barriers to switching are indeed higher at this point. So, as soon as you reduce the barriers to switching, then your customer base is a lot more nimble, and then you have to compete much more aggressively to keep them. The second issue, which is also a regulatory issue with the cloud, is that you're incredibly dependent on the cloud providers. So there was this very famous incident last year, which is when AWS went down for a short period of time, Amazon Web Services. And hedge funds were in a complete panic because a lot of their data and their processing systems were up in the cloud, and they didn't have the ability to react very nimbly to important market movements that were happening at the time. So, from the perspective of the regulator, this is a risk factor that they need to be able to manage, and they need to be able to comprehend and understand how to establish a regulatory environment with very new risks of the type that they hadn't contemplated dealing with before. So, I mean, I think if you sort of put all of these things together, we're in an extremely complicated regulatory environment. I mean, there's many different things that are changing extremely rapidly. And so what we have is a situation where it's no longer the case that, people are innovating and then the regulator comes in and sets the ground rules. The regulator has to learn on the fly what
Mm,
ground rules are appropriate at the same time that they're setting policy, which is a pretty unusual environment given how quickly innovation is occurring in the system. So I think what we'll see is a lot more cooperation between regulators and innovators. So in cryptocurrency, for example, there seems to be sort of as much there's sort of bi-directional kind of learning that's going on at the moment, despite threatening noises.
interesting. Yeah, wonderful. And we have Cynthia back on the panel. Welcome back. We're very glad. We hopefully fixed some of the technical issues. But so I wanted to bring you in, Cynthia. What we were talking about is looking at regulatory compliance challenges and whether these, sort of are a barrier or a hindrance to some of the issues that we're talking about. I wanted to get your view now that you're back with us about what you think some of those regulatory challenges are.
Yeah, just building up on what Taryn has said, I think there is an opportunity for this bi-directional influence between regulation and innovation. We have directly seen that in the sector we work in, where by innovators providing ways for financial institutions to be more compliant faster in a more cost-effective way, you actually are well positioned as a partner. And on the other side, endear yourself very much to the regulator, because in the end, you have a more robust economic and financial environment, and that's ultimately what the goal is. So while we've seen that conversation initially set up as a bit antagonistic, and certainly some innovators have taken it a bit more of a less collaborative approach, we've actually seen a huge benefit on both ends by innovators positioning themselves as partners on both ends, and driving that process forward in a much more cost effective way.
No, interesting, great, and wonderful. And your sound is a lot better as well, so it's good because I'm glad our audience gets to hear more of what you have to say. So, Anna, I saw when Taryn was speaking that you were nodding your head a bit on some of these issues. So I wanted to get your views on the regulatory challenges.
Yeah, so I was nodding because indeed digital technology has such a great potential to disrupt the finance sector, and we're seeing that. But we really need to take caution about the any unintended consequences, right, if this disruption is not guided. A couple of things that I see are around data governance and ethics. So once you unlock the data, the next question is, well, what are the limits to its monetization and its fair and transparent use? The current fintech regulation is very fragmented, and I think in the absence of a level playing field and common rules, there is a risk that we end up in a situation, of a race to the bottom. Now, I would argue that fintechs provide an enabling environment for banks to open up the data, and that the ultimate liability sits with the banks, but I'm open to be challenged on that. And I think it's all the more arguments that this is something where all market participants really need to work together, sit down, at the table and define these rules. The other issue is around scaling. So the key benefit of open banking is that it virtually has no limit to the number and type of third-party data sets that banks can tap into. And as that ecosystem grows, it becomes even more challenging to kind of track and align how many flows across accounts, borders, financial institutions, and so on. And I think this absolutely needs regulation. Otherwise, we're at risk of undermining the very benefits of kind of transparency, data transparency, right? That open banking provides, and digital technology. And the other issue, and it sits somewhat on the periphery, that we're not really talking about it, but it's about high environmental costs of digitization, right? On the one hand, of course, cloud migration, it helps reduce energy consumption and emissions because of operational efficiencies. But on the other, open banking will demand more data. It is powerful because it processes a lot of data, right? And that will require more data centers, more resources to build and supply them and power them. So we have to be really mindful of how we also regulate that and kind of design the digital world. So these are the kind of the three bits that I see right now that need attention.
No, interesting. Now my next question is a little provocative because I always like to see where are all the issues that are driving some of the trends that we're seeing in the industry right now. Like the most banks are going through some sort of digital transformation or a digital first movements right at the moment, and there's a lot of efforts to create internal efficiencies, and also many in our industry are rethinking kind of banking's role in society. You mentioned ESG, both not just the environment, but also in governments and its impact on society. And all of those things are very good, but banks are also, in business to make money. And when you look at what is said and what is the purpose of all of this advancement, is really is it more about meeting customers' needs and understanding that impact in society, or is it about looking for more profit from existing customers and new customers? And where does the PR move into sort of an actual banking environment of what we're talking about? So, and I am going to go back to you on this about, like, I know ESG and sustainability and environment and society's impact is a huge issue right at the moment, but how much of a priority, how much is this actually driving what we're seeing in the industry right now?
I'd say that it's certainly driving the discussion, right? And in the past, and in recent years, there's been the sustainability and the finance profession have been coalescing around this one question. Well, what is the role of finance, and essentially bring us
Mhm.
closer to the world that we want to be in? So there's been a lot of reflection about the role of banks in society. Um, what I'm seeing and what's happening right now, and COP will sort of reconfirm that as well, or reemphasize that again, for the first time, capital market regulators are really trying to fix and have a better understanding of what are we financing, right? What are we enabling with money? For example, the EU, they're putting various legislative acts under the Sustainable Finance Package. The UK just yesterday released a policy roadmap for greening finance in the UK. We have the Securities and Exchange Commission in the US that is looking into enforcing climate reporting for listed companies, and that will also include those in the financial sector, right? So banks, insurers, pension funds, and so on. Similarly, IFRS plans to announce at COP26 next month at Glasgow their roadmap to developing sustainability reporting standards. And there, it's not only about financial stability and risks to financial stability because of effects of climate change. It's also about actually financing the transition itself. And we know that there's just not enough in the way of public finance to finance the transition to net zero, low carbon economy. And the government will inevitably come to banks with with a request to support that. So that is there's a lot of demand for sustainable finance right now from the regulators' side. But certainly, as I've said, right, consumers are asking themselves these questions. So all of this
Mhm.
drives demand for the banking products, and digitization here can really accelerate this transition that we need.
So, Cynthia, what are you seeing? What are you seeing that is driving these trends then?
Yeah, I mean, we are, and just building up on what Anna said, there's a lot that's happening at the policy level, at the capital markets level. We're privileged to work at and with banking at the last mile, and the impacts there of climate change are less viewed from a policy lens as from literally sort of failed harvests if the weather changes and so on. And I do think for it to actually succeed, when you look at banking being actually extended to, or financial availability of financial services being extended to every human on the planet, I think there's going to be an increased need to get more of that input from the last mile. So that when policy is made and when decisions are made, it's also in consideration for some of the day to day. I think topics that are dealt with that are not necessarily immediately visible. Another thing that we've observed that has been really helpful is an alignment of incentives. So what we see with institutions like credit unions, because their members usually are part owners, they tend to have a say in how the bank is run. And that say usually comes from their own lived and personal experiences, and that defines the products that the credit union then offers. It's a bit more of an extreme version of younger consumers sort of maybe saying or demanding more visibility into their climate impact or carbon impact. This is
Mm,
very direct ability to influence the direction of that financial institution. And I think there's a lot that can be learned from community organized or community owned financial institutions that have already built in that feedback mechanism on, hey, how do we make it a better institution and therefore better service based on our day to day and lived experiences. So I'd love to see those come together. I'd love to be able to engage both at the COP26 level, but as well at what is happening when a group of farmers have to come in and find insurance products for a failed crop or so on. That's the bit I think still needs a little bit more investment and effort.
mm. It's interesting. So Taryn, both Anna and Cynthia really talked about this power of the customer sort of finding their voice and making it very clear to the banking industry what priorities they have and the context they're living in. So how do you view this? What is driving some of these trends from your viewpoint, Taryn?
Yeah, I have a very different perspective on these issues. And I think, I mean, I have a less utopian perspective on these issues. I have a little bit more of a dystopian perspective on these issues. And this is guided by my own work on algorithmic discrimination with large data sets, which is a topic that is extremely important when it comes to big data and the uses of big data in an environment when you can very quickly de anonymize people and privacy protections are not necessarily always in place. And so in my own work, we show that if you apply machine learning algorithms to credit screening, that you can significantly disadvantage racial groups, ethnic minorities, using large data sets of mortgage data that we've been looking at. So we sort of put together some theoretical frameworks and also show that some of these tendencies do exist in the data. So there's a slightly more dystopian view here, which is that the pursuit of profit and the adoption of new technologies, especially in an environment where the regulator is not able to keep as quick pace with the speed of innovation in the fintech screening sector, can result in outcomes that are pretty worrisome, pretty troubling, to be honest. And I don't think that we've, as a society, thought through data and data governance and the privacy protections that are necessary for these systems to be in place. I mean, I think there's a little bit of a tendency that we have to kind of chase the next new thing. So as soon as technology came in, everybody was about technology. Now there's sustainability. Everybody wants to be, greenwashing themselves to look really fantastic on the climate change front. And I think there's a little bit of a tendency, and this is perhaps my academic side coming in, of sort of, doing about 50% of your homework and not doing 100% of your homework, and then moving on to the next exciting assignment rather than completing the one that is put in front of you. And I think the problem is that you're going to have, a reasonably large set of unsolved issues. Now, let me tell you how this might become a serious issue, which is even if you do get regulatory infrastructure put in place in certain jurisdictions, like, for example, in the United Kingdom or in the United States, there's a lot of jurisdiction shopping that's happening. And so you might expect that what's happening is people then say, oh, it's all about financial inclusion, and then we're going to go off to India, or we'll go to China or Southeast Asia or Africa. We're going to expand our franchise. And what's a little bit overlooked is perhaps the regulatory infrastructure is not fit for purpose. And so digitalization, big data strategies are going into these areas. And it's almost like the equivalent back in the day of shipping environmentally polluting industries off to countries that had fairly low climate protections. And I think the same sort of thing is entirely possible in finance. And we need to think about that very carefully. And there needs to be coordinated action on these topics.
So I wanted to stay with you because we had a question from the audience, which was why have we not seen an advance in the prevention of fraud. Now, I mean, when any people talk about preventing fraud, they bring in solutions of bringing in more data, bringing in AI, bringing in a lot of these technologies. I mean, how do you balance that with what you're talking about, the ethics of data, and then the very real need to prevent global financial criminal activity and fraud, and prevent fraud? How do you kind of, how is the industry's kind of balancing that right now?
No, I mean, I think this is an interesting question and it does link up because obviously there's an arms race, right? So, it isn't as though the regulators kind of plug a couple of loopholes and then all is well forevermore. I mean, that's never the way it works. This is really like, the old Dutch parable of the boy with his thumb in the dike. And, there's another, pretty quickly, there's another hole somewhere else. And, before you know it, there's a flood unless you're very careful. And I think what you have to do in this kind of environment is that regulators have to constantly upgrade their skills. And indeed, I am very much an advocate for more muscular regulation in certain areas where we actually know that the possibility to cause harm is fairly large. Now, there's another question, of course, about enforcement, which is, part of the issue at the moment is that, as finance becomes more decentralized, which is undoubtedly a tendency which I think is very good, there is also more and more jurisdictions, and indeed unpoliced jurisdictions, where activities can occur. And so this poses significant problems, which is, I think, one of the main reasons why central banks are thinking so hard right now about digital currencies.
So, Anna, I know you wanted to bring in and make a point on this topic, so go ahead.
Well, yeah, partly I was nodding, agreeing with Tanner, certainly about, the implicit kind of social biases that we have and that we continue to bring in technology, I think. So we have to be very careful with rooting those out. But the other comment I wanted to make was around, chasing the next best cool thing. And when it comes to sustainability, really, this is not new. The U.S. SEC, for example, they have been requiring climate disclosure for 30 years. It just hasn't somehow, received the necessary attention. And ahead of COP26 right now, there's a lot of events happening all over the world. And just yesterday, we were sort of rewatching, with a group of sustainability professionals, The Inconvenient Truth by Al Gore. 15 years he's been talking about these trends. 15 years we know this, and the trends continue, right? Not much has changed, unfortunately. And there's a question in the chat, right? So what has changed in banking in terms of sort of ESG strategy? Well, if you think about money, and I think it's a question to our listeners, right, for everyone to reflect, what is the role of money? What is the function of money? Money is an enabler. It's just facilitating things activities that are relevant to relationships between humans, right, that we agree that we need. And from that perspective, banks need to really understand and get to the bottom. Okay, what is the final destination of their capital, of their investments, right? Is it facilitating fundamentally destructive activities or not? So that is something that we need to focus on right now. That's what's happening, because banks, themselves, the banking sector, you can say, well, we don't have a big footprint, but if you look at what's actually being enabled through money, then that's where the question is. And banks need to understand that and decide for themselves, how they relate to this information when they have it, and what decisions
So,
they make as a result of it.
No, interesting. So, Cynthia, I haven't forgot about you. I know you want to weigh in. We're having this wide ranging discussion about data and ethics and society. So, Cynthia, I'd love to hear your thoughts.
Thanks, Liz. I mean, I do agree with a lot of what Tarun has said, and sort of the blanket application of modern technology also results in the blanket application of all the ideas and biases that went into creating that version of modern technology. And we've always had an opportunity to look at it from the other point of view. What if you start with the existing needs of whatever problem you're trying to solve, and only then apply, either innovate in that context, or then apply technologies from that previously have been used elsewhere. And we've seen dramatic effects in building out decisioning models that are built and around a specific community, which on another if they were to be decisioned by any other model, would not be considered yeah, let's say valuable or credit worthy. And so, as much as we do advocate for new technologies becoming widespread, I do think it's an incredibly important point to raise that the blanket application of that will and would actually result in just the transference of biases or transference of existing frameworks that are actually quite exclusionary. Now, what is a path for innovation to go the other direction, right? I think it does still always come back to the customer needs. If innovators are actually genuine about solving individual customer needs and building from that, then there's a higher chance we can avoid some of the biases. But I just wanted to build on that because there's an additional question about what's going to happen in less developed countries where even the
Mm.
affordability of technology becomes into question. And I think it's the same point. There should not be an allowance or some room to allow for either lower standards or these biases to go through simply because of the existing nature or lack of availability of technology in a certain region. So I think it's fantastic to have all these different points of view on the same stage, and hopefully that sort of continues because I think that's one of the best ways to go forward.
Yeah, no, it's interesting. Yeah, you pointed out a question from the audience that said, what will the least developed countries' banks do? Because the majority of the clients are not used to the use of modern technology, but a small share is modern and updated. So a technology mix is also needed. I mean, actually, was we've got about 8 more minutes for this panel, but I mean, our last question was really we talk a lot about bringing in new technologies to solve a lot of the problems that we've talked about, but I think our discussion is that technology is not maybe not necessarily the silver bullet that we think it is, and there are many other issues at play. So Taryn, maybe I'll go to you to a bit about what is this mix of technology and other issues at play that we're dealing with.
No, I think this is an enormously important point. So I wrote a policy report for the Indian government in 2016, which was released in 2017 by the Reserve Bank of India, on precisely these issues of bringing technology-enabled finance into India and trying to think a little bit more about the barriers to adoption. And it is true that it isn't just the case that in places like India that there is a vast gap between the sophistication of the least sophisticated and those of the most sophisticated. That is true in the United Kingdom. It's true in the United States. I mean, there's a vast gulf in the level of understanding as you go across the income and education spectrum, and the possibilities for exploitation are substantial. I mean, it's not just about exploitation. It's also about the fact that if you want to solve the last mile problem of adoption, then you need people to confront not just technological adoption issues, but also behavioral issues. So, for example, you cannot ask someone to download an app and sort of use it and reveal their ignorance to other people of the fact that they have no idea about what language it is that you're speaking when you say the word app and platform and download and things like that, if they're simply unfamiliar with these technologies. And there's a lot of shame and there's guilt and there's behavioral adoption issues that come into play, which are very human issues. And I think, the technology sector in finance is becoming a lot better at sort of crossing that threshold and sort of helping people across the digital divide. But I think this is an ongoing issue, and I think it's one that we need to sort of blend. So as we do more on the technology side, we need to complement that with behavioral economics to really allow people to sort of make the transition from one state to another and become very comfortable at transacting in this new world.
No, I agree. I've had long conversations with my elderly aunt about what the cloud is when using her Kindle. So I understand what you're talking about as well. I don't know, Anna, you were nodding your head a bit with what Taryn was saying. I don't know if you want to.
Well, I was nodding. I was just thinking, about a case, not so much related to banking, but that we were all exposed to recently during COVID. Everyone who has children has seen that when schools transitioned to working offline, families that didn't have computers or weren't able to procure them, they were left out of that system. And I think that applies very well also to the global digitization trend that we're looking at, right? What about countries where that are not covered by the internet, that are not covered by the digital technology. I mean, will they be excluded? How are we going to bring them in? But also those that are lagging behind in indeed understanding all of these technologies, right? Even I myself, I'm guilty of sort of understanding all of the, all of this stuff. So there certainly needs to be more control and guidance and regulation and ultimately some sort of top down, I suppose, or rather collaborative approach to deploying this in a way that is inclusive and that is fair and that is transparent.
So we've talked a lot during this panel about technology and society and data and sustainability issues. There's a question here I just noticed, which is very interesting. It says it feels like traditional banks are facing so many challenges that they cannot rise to. This is inevitable that they will die slowly. It will be long and drawn out, and that is why we don't really notice. Does the panel agree? The reports of banks' death, are they exaggerated or are they inevitable? I don't know if anyone wants to pop up and make a comment on that in the last few minutes.
First of all, I think the description is very evocative, and I think that's worth something. But I mean, I think if you look back in history, it's really about the potential to adapt. Through many disruptions, for example, financial houses have been around. I mean, some of the same names that were around at the turn of the last century are still with us at the turn of this century, and if anything, have gotten bigger and more consolidated, and so on and so forth. And I think the point here is about industrial organization, which is that it isn't the case that you're necessarily going to be a dinosaur because you can always buy. And so the important thing to remember is that acquisition is a real strategy for survival in the new world that we have. That having been said, I think the crises that we face at the moment, especially with climate and with many of the things that we're facing, are really challenges that are at a scale that is very different. And uh, it would be interesting to see how people weather this shakeout. But yeah, I mean, I think the reports of the death of the established banking franchises are probably somewhat exaggerated, is my guess.
In the last 2 minutes, does anyone else want to pop up with a viewpoint? Cynthia, did you nod your head?
Yeah, sure. I mean, as much as I do agree with Taryn that there's ways to mitigate a death, I think it's important for any sector to face an existential crisis and just look at why do we exist and is there still that reason? And especially as you mentioned, the scale of challenges sort of magnifying outside of what was previously maybe easily within human control or what felt like it was within human control. So, for as much as they may be exaggerated, I think a little bit of that paranoia of like, okay, well, can we continue to exist in this way is what would actually support us moving towards better solutions faster. Whereas if it's, any there's um, it's infamous how many entities have claimed invincibility, right? Those could also be some famous last words. So I'm very much pro that kind of provocative question across all sectors, and especially as the magnitude of challenges we face yeah, they magnify.
Excellent. Anna, any last words before we wrap it up?
Yes, just agreeing that we have to continue asking ourselves the question, what does future banking look like, right? What is the future? What is the world of tomorrow that banks need to support, and what do they need to do now to remain for their products to remain relevant in that future? I think TCFD has put out a very good uh, years ago already approach to that, where it's asking banks and financial institutions to understand, okay, well, how are you exposed to physical transition and various liability risks, and once you have that information, what do you do about that? So that's a good way to kind of backcast a little bit from the world of tomorrow to where we are now, and take the necessary steps to mitigate and be prepared.
Excellent. Thank you so much. Thank you so much. And we're exactly to time, which is excellent. Cynthia, Anna, and Taryn, thank you very much for a very interesting and wide ranging discussion.
Thank you.
Thank you.
Thank you, Liz.